Welcome to the daily update, where I'll go over the action in the market for Friday, October 13th, and then we'll see how things look for Monday, October 16th. We saw another down day, still working off that overbought condition, but we pretty much have worked that off now in the short term. We did drop, but for right now anyway, support is holding right at the August 2022 high. So we're still looking more positive than negative. We want to watch things from here, seeing will that support level hold? Will some buyers come in and start to push prices back higher? But in the meantime, the market's kind of in a mixed point right now, deciding if it wants to break higher or lower. So let's go back and talk about what happened. We did have a higher open, but prices didn't get all the way up to R1 at 43.82. After that, prices fell down below the daily pivot. We also fell below the unchanged level. We found support at the August 2022 high, which is at 43.25, and that's pretty much where we spent the rest of the day. We chopped above and below that high, and then we ended up closing just a little bit above it. So we were down 0.5% on the day on above average volume. And as I said, our technicals, they're still leaning more positive, but we need to see follow through price action. We've had a couple of down days now. We've got a weekend with a lot of geopolitical things happening. What's that going to do to things when they open on Monday? And then how will things play out from there? It's about inflation, interest rates, growth concerns, and the big geopolitical event, what's going on in Israel currently. What are some comments that we can make? Mega caps did underperform in Friday's session. That's where the real leadership in 2023 has come from. And it just didn't happen in Friday's session, and so it took the markets down with it. We did have earnings that came out from banks, the big banks, and they were taken as positive. Oil is still, it actually advanced. This has declined. It advanced up to 87.69. The micro caps are hitting another 52-week low. That's not a real good sign. It's not massively negative, but we just want to see in a healthy environment the micro caps and the small caps doing better. We only have our stochastics that are giving us an extreme positive reading now, and that's because we have 3 different charts that I show you on that one chart, and I'll go through that. The current scenario still seems to be in play, except we now have this geopolitical situation in Israel to add to the list, that the economy is stronger than expected. The Fed's going to need to keep rates higher for longer. If we keep seeing economic reports that come in stronger than expected, perhaps they're going to have to raise rates. Keeping an eye on the Chinese economy and keeping an eye on oil. The dollar was up, which put a bit of a headwind in the price of stocks going higher, and interest rates were down, which actually gave them a little support from falling even further. The 30 to the 5 is the only yield curves now that's back to normal. All the rest of our other yield curves still are inverted. Sentiment continues to be negative. We had been at 35. We dropped down to 29. Our trend is positive, but the ADX is weakening. It's below its moving average, and the green line and the red line are pretty much on top of each other now as the market is going back to this point of being at an inflection point. We're still above 20, so even though the ADX is coming down, we're still in a trending environment. And even though we had the down day on Friday, I'm keeping our bias right now at mixed and our momentum at mixed. I mean, how's that for being committed? The economic reports that came out, and I don't have charts for all these because they're not big influential reports. Export prices came in up 0.7%. Last time they were up 1.1%. If you take out ag or agricultural products, they were up 1%. Last time they were up 1.5%. Import prices were up 0.1%. Last time they were up 0.6%. If you take out oil, they were down 0.2%. Last time they did come in down 0.2%. Consumer sentiment, which I do have a chart for this. This is the preliminary reading, and then in 2 weeks, they'll come out with the final reading. It came in at 63, which was lower than the 67.5 they had expected, and down from the 68.1 that we saw last time. So here is consumer sentiment. The main measurement here is the blue line, where it's showing it's dropping off a little bit. There's a lot going on in the world right now for people to not be happy about. When you look at expectations, that's the yellow line, where people are actually not as positive about things looking forward. And then how do they feel right now? Well, a little bit better, at least at the time being. Here's our chart showing the difference between the 2-year Treasury yield and consumer sentiment. where they're tending to go in opposite directions. And we've seen that now for almost 2 years, where they usually have a tendency to go in the same general direction. Here, they've been going in opposite directions for quite a while now. We did close at 4.63% with the 10-year yield. That's still above the 4.02%. So we're still in that area where this could be causing some concern for company earnings, which ultimately feeds through to stock prices. Here's the intraday chart where we did gap higher. We actually opened right at the previous day's daily pivot, and that's where we set the high right after the open. We came down to the daily pivot for Friday session below the unchanged level, all the way down to the August 2022 high. We bounced off of that. And you see, this has been pretty significant support now. Well, we fell a little bit below it, and it was probably just enough to take out a lot of stop loss orders that were stuck in here. People that just had their orders right below this level, took them out, and then we came back up and then danced along this August 2022 high and then closed just a little bit above that. Looking at growth versus value, where the blue line is still above the red line, where value was down, growth ended up being up for the session. So this is still hanging in there for now, and this is more under the surface and looking positive. We're going back to about the 22nd of September. We've been seeing a pretty consistent rise with growth outperforming value on an intraday basis. Looking on an end-of-day basis, we're also showing where growth is outperforming value. So this is more under the surface positive. But looking at our trend, it's just a mess right here. All these lines are pretty much coming together. The thing that's a little easier to see is that the ADX, which is the black line, is below its moving average. And we have the green line and the red line. They're kind of on top of each other. It's really hard to read this right now. And I try to look at the numbers over here, and it's not really giving us all that much insight. So this is just kind of a jumbled mess for the time being. And we're seeing kind of that same mess with our short-term ADX. This is starting to drop below 20. So we're kind of possibly leaning into going into a trendless environment until the market adjusts and decides which way it wants to go. We're also coming up to the middle part of October now, which on a historical basis, this is usually when the VIX will top out and then start to go down. That could be positive for stocks. But at the same time, we have some negative seasonality based on averages of what's happened in the past, especially during pre-election years, which could suggest that we might see some weakness later in October. The Ulcer Index continues to decline. It's dropping below its moving average, showing fear has been decreasing. We did climb with the VIX on the line chart as well as the bar chart. We actually got above 20 there for a little while, but then we ended up closing down near the low for the session. Looking at the VIX of the VIX, volatility really did pick up in Friday's session. There's this whole day of jihad and craziness and everything, and now the media is starting to turn against Israel. And so you probably had a lot of folks that wanted to be able to hedge their positions over the weekend. So that's probably why we saw a bit of an increase in volatility. The VIX to VVIX ratio continues to be negative as it's going up. That's the opposite of stock prices. And the VIX to move ratio did pick back up. We're seeing volatility increase, especially in the VIX ahead of the weekend, when compared to the MOVE index, which measures the volatility of bonds. Looking at the equity put call ratio based on 5 periods, this is somewhat negative and a little discouraging. We're turning back up slightly. It might be kind of hard to see there, but if this is going up, that tends to be more negative for stocks. Longer term, the equity put call ratio based on 253 periods, it's continuing to go up. That's longer term negative. The ratio between risk on and risk off, it was down in Friday's session. It's pretty much been chopping sideways. I didn't even show this chart in yesterday's video. Looking at our advanced decline line, we're still above the moving average based on price, but we did decline. We're declining below the moving average based on volume. We're still seeing some improvement here with the 5-period simple moving average of the new highs and new lows. We did see a bit of an expansion in new highs, even though it was less than what we saw on Thursday, but we also saw an expansion of new lows, but less than what we saw in Thursday. So that's helping our overall trend to show a little bit of an improvement. We're dropping below the midpoint now with our advanced decline ratio. That's more slightly negative. Accumulation distribution did turn down, but it's still above an advancing moving average. The chicken money flow has now switched back more to positive. So that could be something good to hang on to there. We're right at the long-term trend line now. We came down and settled pretty much right at that spot in Friday's session. On the bottom, you can see where volume was above average. And we're still above this line here, the 0 point, denoting that on an average basis, volume is still above average. We're starting to drop negative, though, with the force index, where we had gone extreme positive. We worked that off, and now it's actually dropping below 0. That's slightly negative. The stochastics in the short term, after being extreme positive, are now dropping back. We're turning down and still kind of extreme in the intermediate term. That's why this is still on the list, but we are showing some improvement in the long-term, short-term stochastic. Looking at our 20-period double and triple exponential moving average, we did come down and we're right at the blue moving average, which is the triple exponential moving average. It's a little hard to see here, but if this green line could cross above the blue line, that would turn things more positive. That one moves faster. Looking at our regular 20-period simple and exponential moving average, we closed right down at the simple moving average for the 20-day. So right now, that's providing support. The Swenlin trading oscillator did turn down based on price and volume, but we're still above 0. The go-no-go system remains with a lighter shade of purple. The TTM squeeze continues to chug higher. We haven't quite turned positive yet, but this is showing that momentum is positive. The balance of power did decline, but we're still slightly above the dashed line. And the highest high, lowest low values, we came down just a little bit below the midpoint now. And you can see the blue line and the red line are getting closer to each other. We might go into a sideways consolidation phase. Now, that's just what this chart is suggesting. We'll have to see how it actually plays out. And coming down to the midpoint of the Bollinger Band, not getting an extreme reading, but just showing that as of Friday, the markets are kind of at a tipping point. The vortex continues to be positive. Even though we were flat with the green line, we're declining with the red line. And the ease of movement was also flat, but still above 0. That's positive. The bullish percent index continues to advance after getting extreme below 30. So that is positive. And our summation index based on price and volume continue to advance. That's positive. But we have dropped below the 0 line with our NYSE McClellan oscillator. So that's going to slowly turn down the summation index. Pretty hard to read right here, where we're rolling over a bit based on price and volume. And we've turned over to negative now with the Elder's Impulse system for the S&P. Unbalanced volume is right back down to the moving average now at the tipping point. The Copic curve is still generating a buy signal. And this is, I haven't shown this in a while, the Pring bottom fisher could be signaling a buy signal now. The black line has crossed above the red line. Now, we didn't really see any real strong capitulation. If anything, we came down close to the 200-day simple moving average. Don't know if that's really strong enough to take this signal seriously or not. Well, again, we have to use other charts to try to confirm that. The RSI based on 14 periods and 9 periods are turning a little bit more negative. They're both dropping below 50. However, the momentum is still positive. The PMO is positive. We're rising based on price and volume. The PMO study, we saw a little bit of a decline with the PMOs that are rising. We're flattening out with the buy signals, turning down slightly, but not extreme with the PMOs that are above 0. We ticked down just ever so slightly with the NYSE bullish percent index, but this is positive. The NASDAQ 100 bullish percent index did advance in Friday's session. The slope oscillator on a short-term basis suggests that the momentum is positive. The MACD is also looking more positive. So all of our oscillators are pretty much positive now. We're just crossing with the tricks in the KST. Those are our longer-term oscillators. We're still below the 50-period moving average here. The blue line is the exponential moving average. So we're dealing with the 20-period simple moving average and the 50-period exponential moving average. The 100-period moving average, we dropped below this. The red line is the exponential moving average, where we spent a number of days in between the two. In our moving average tree, we're dropping down here to the blue line, which is the 20-period simple moving average. And this is kind of a mess right now, makes it a little hard to read. We're a little bit below the midpoint with our standard deviations chart. The Chaikin oscillator has turned down, but is still above 0. The money flow, right about at 50. Actually, it's just a little bit below 50, so that's slightly negative. The ultimate oscillator is declining, but still above 50. The parabolic SAR, though, continues to be positive, and we're right at this fib level here, the 100% retracement level, that's about where we closed on Friday, which also means we closed just a little bit above the 61.8% retracement level on our longer term fib chart. We're coming down into the middle of this mini rainbow when we look at the 20-period simple moving average of the open, high, low, and close, just showing that the market is setting itself up because it doesn't really know what it wants to do right now. We also closed right on top of this long-term trend line. Special K is right on top of the red line. The 50-period moving average study for the S&P did decline slightly after giving us an extreme negative reading earlier in the week. We're showing a little bit more weakness with our 19-day exponential moving average of the advanced decline ratio, where we had become extreme negative, both based on price and volume. We climbed above the midpoint, but now we're starting to come back down with both charts. We're still setting new lows with the microcap index. Heiken Ashies turning a little bit more neutral now, but that could be negative because the candle is black. We're also positive, but pointing down with the Kegi chart. The Renko, though, still continues to be positive, and the 3-line break is positive. So we're seeing a mix when we look at our different chart variations. We turned down a bit with the equal weight index. We were also lower with the weighted S&P 500. We also came down a little bit when we look at the ratio between the two, but as this is going up, that just means the mega caps are really outperforming. The Dow is still below its 200-day moving average, so that is somewhat more negative. And the diamonds, after having been neutral, have now switched to positive, and they were up slightly in Friday's session. The NASDAQ 100, this is where we're getting our stronger support and resistance from. Where we came up to this previous high, we were not able to break through that on a closing basis, but we were above the 50-day moving average. Now we've dropped down slightly below that, but we're still above this monthly pivot level. And we switched over to neutral for the Elder's Impulse system. But on a momentum basis, the NASDAQ 100 is still above its moving average. It's rolling over a bit, and it's still below zero, but it's still looking more positive. The NASDAQ also dropped below its 50-day moving average, also closed just a little bit below this pivot point. And we're kind of in between here with our Fibonacci levels. I brought this up because if we continue to fall, we might come down to this 50% retracement level, but we were jockeying above and below that for a number of days. If we do turn positive next week, then we'll be watching the 61.8% retracement level. The small caps are just having a lot of trouble now. They had a few good days, and now they're right back down to about where they started and generated a recent death cross. Looking at the Russell 2000 small cap index, we're turning more negative with the RSI. We're not quite at a death cross yet for this index, and we're starting to look more negative with the MACD, where it could begin to cross over the moving average. And the Elder Impulse system for the small caps remains negative. And the small caps are really underperforming the S&P. That's not what you want to see in a healthy environment. The mid caps also, we're down in the session, still below their 200-day moving average and not really at support currently. Where the mid caps for the Elder Impulse system still remain negative. They are red. Then looking at our 200-day moving average study, we turned down just a little bit with that, both with the 200 and with the 50-period moving average study. The FANG index closed right on its 50-day moving average. Again, another tipping point and showing market indecisiveness right now. And we're just a little bit above this longer-term trend line going back to 2009 when we look at the arithmetic scale chart. When we look at the staples to S&P 500 ratio, they did tick up slightly, but overall they have really been declining, which often gives support to the S&P. Looking at growth to value, where the Qs turned down a little bit, but they're still above their moving average compared to the S&P. Discretionary is showing a little bit more weakness right now, and that's a bit of a concern. We turned down a bit, but we're still above the moving average when we look at large cap growth versus large cap value. With our different growth to value ratios, the large caps, the mid caps are still above their moving average. They're getting down a little bit closer to their moving average with the small caps. We're still negative here, even though we saw a little bit of a bounce up. Our 50-period exponential moving average of the new highs, new lows is continuing to be longer-term negative. Here's the actual indicator where we closed just about at zero in Friday's session. We had been positive for a couple of days. We're wondering if that will help turn the 50-day moving average, which is the red line, back up. After giving us an extreme negative reading with the 10-day average of the S&P highs minus the lows, we have been bouncing up out of this, and this takes longer to calculate. So that's still hanging in there and looking more positive. The dollar continues to advance ever so slightly and is in an overall uptrend. In this upcoming week, we will come up to October 17th, which will be the end of the current 50-day cycle. Sometimes that can mean something. Looking at bond yields, where we really spiked up earlier on, well, we ended up being down in Friday's session, which probably helped stocks from really falling apart because interest rates were coming down. The 30 to the 5 is still looking more normal, where the rest of our yield curves are back to being inverted. We're still seeing a pretty strong correlation when we look at the top chart, which is the 10-year yield subtracting the German 10-year yield, and that's having a strong tendency to go in the same direction as the US dollar index. So that can give us some insight as to what's happening, and they're both going higher. Looking at Tom Bowley's research, where for the month of October, the staples are not strong, where the financials tend to be strong. And we just had some earnings reports from the banks, so that could help the financial sector. We're coming up more into the part of the month now where we tend to be a little bit more positive, but then as we go through this upcoming week, we'll be coming into a section where we tend to see some weakness after that, and that'll be coming up in the near future before we see some strength coming into the latter part of the month. So what's our outlook for Monday? We still have this UAW strike that's continuing. If you're involved in that, either directly or indirectly, you're probably really paying attention to it. But it's all the news that's going on in Israel right now that everybody's fixated on. It looked like they were going to put up Steve Scalise as possibly being the new Speaker of the House, or at least voting on him, and then he ended up dropping out. Now it's Jim Jordan. We'll have to see, is he going to get the support that he needs, or are they going to have to go and pick somebody else? And then we're dealing with the Israel, Hamas, Hezbollah, and I'm including Iran in this whole equation. Even though there has officially not been any proof that Iran's directly involved, I don't think that's a real stretch. The technicals are showing some improvement, and we're still saying positive in the short term. We're working off of that overbought condition right now, but we keep wondering, is this little fizzle that we saw earlier in the week, is that starting to go away? We don't know right now because the market is kind of right back to an inflection point. We will get the Empire State Manufacturing on Monday, and that's it. And then keeping an eye on all the geopolitical events, with Israel pretty much being at the top of the list. Here's the calendar for the upcoming week. We're going to get retail sales on Tuesday. That's a big part of the economy. And then we're going to get a lot of housing information in the upcoming week. We'll get LEI on Thursday. So we don't have any big reports coming out on Friday, but a lot of the real estate and housing information will help direct that part of the market. The Stock Traders Almanac for October 16th, we're neutral to positive across the board with the Dow, S&P, and NASDAQ. And then we're still trying to figure out here, we have a sitting president who is running for re-election. Are we still into that positive time before we possibly see some historical weakness? Seeing that same thing, and I tried to put a box around this, but these lines on here, it's not really easy to do that. Is this the bounce that we're seeing before we tend to see some weakness coming up later on? Seeing that same thing with the NASDAQ and the same thing during a pre-election year with the S&P 500. Again, it doesn't mean it's going to play out this way. We've already deviated from this a little bit in October. There were some days when we stuck right to historical norms, but other times when we've gone in a different direction. We just use this as a guidepost. And then we tend to be up a little more than down during pre-election years for the S&P going back to 1950. Looking at Bitcoin, where it doesn't really look like we're seeing that nice little bouncy time here, which is the green line. We're really, in fact, Bitcoin is going down. If anything, it's going sideways with the blue line or the black line. And here's an updated chart where we were up slightly. It's just barely above its 50-day moving average. It's not really tearing to the upside like a lot of people are really hoping that it will. So our scenarios, not really going with the down one right now. If anything, we would lean more to the upside because our charts are still positive, but we're still at that inflection point. So we want to be sure that we have more confirmation, and we're possibly getting close to a sideways trend, but we're not quite there yet. So the warning signs, October can be a positive month. It can also be an ugly month at the same time. The longer-term equity put-call ratio is going up. That's negative. The equity put-call ratio, I've switched it back over to this slide now. It's ticking back up, which is negative. The risk-on posture continues to show weakness and really hasn't been moving much lately. The 50-period new high, new low, exponential moving average study is negative. The Russell's below its 200-day simple moving average. Well, I've never had a 2,000-day moving average. Wondering if we're working off of a head and shoulders top. The small cap index, though, has generated a death cross. The positive signs, the daily special K chart, it's right on top of that moving average. We don't know if it's going to switch over and go negative or if it's going to be able to turn back up and go positive. All of the oscillators, though, are turning positive. So on a momentum basis, we're still hanging in there. The parabolic SAR chart is positive. The BPI has generated a buy signal after crossing back above 30. The Copic curve has generated a buy signal, and the Pring bottom fisher has generated a buy signal. Not really wondering how much to trust that. We want to use it with other charts because we didn't really see any capitulation right before this signal was generated. The vortex is positive. The Staples to S&P 500 ratio, as well as the S&P to the utilities ratio, overall, they continue to be more favorable for the S&P. The Russell and the mid caps, they're below their 200-day moving average. A few more days, and they could give a death cross. Small and mid cap growth, though, still continues to be positive. The financial sector is also below its 200-day simple moving average. The longer it stays below that, the more there might be a death cross soon. So our conclusion, we're turning more positive, but we're kind of right at this middle point right now. We're wondering, is this just a short-term development, or is this going to develop into something longer term? And as of right now, you can make a case for either side, but I would be leaning a little bit more towards the positive side because that's what our charts are suggesting. So we pretty much have worked off being this overbought condition in the short term. We're still turning a bit more positive in the intermediate term. Even though we've seen a couple of down days now, those charts are holding up for right now. In the long term, we continue to be positive. So thank you. Have a wonderful weekend. I will be posting the usual videos over the weekend, the weekly video, the intermarket analysis video, and the deep dive video. So I hope you have a great weekend, and I will talk to you in the next video.